Hello learners. In the earlier presentation, we had tried to understand the concept of valuation of the house. We'll just do that again with the help of an example. Practically, how do we find out the value of the house? So, we'll talk of unfurnished, we'll talk of furnished, we'll talk of rent-free, we'll talk of concessional.
Let's say we have this case where X works with ABC Limited in Delhi. Now see, two things become clear out of this very statement. ABC Limited means is a non-government employee. Delhi means the population is more than 25 lakhs. For the following information for the assessment year 21-22, we have this information where we will do two things simultaneously. One, we'll find out the salary, gross salary, as also we'll find out the taxable value of the perquisite. Now, as per the information that we have, the salary components are basic, 2,40,000, DNS allowance, which is part of the salary, 24,000, fixed commission, so it's not a percentage of turnover, but fixed commission, 6,000, lunch allowance, 5,000, children education allowance for one child, 2,200. He gets a rent-free, unfurnished house owned by the employer. See, so many things are clear to us. 1, it is rent-free. 2, it is unfurnished. 3, it is owned by the employer. And 4, it is in Delhi. And medical facility, 1,200. So practically we have 1, 2, 3, 4, 5, 6, 7 components of salary. So we shall simultaneously do the calculation of net salary and how we value. We have some allowances and we also have perquisite on account of house. So for taxable salary, your basic 240, it will be taken as 240. DA, part of the salary or not part of the salary, it's always calculated for valuation, 24,000. Commission, fixed, 6,000. Lunch allowance, fixed, no exemption for lunch allowance, 5,000. Children education allowance for one child. We have done children education allowance is exempt up to 200 rupees per month per child. So while we are getting 2,200, exemption would be 2,200 minus 100 into 12. So taxable would be 1,000. Medical facility, fully taxable. So for the purpose of computing the taxable salary, we have done basic, DA, commission, lunch, education and medical. Now we want to find out the value of the house. Which house? Rent-free, unfurnished house. Now since the house is owned by the employer and the house is in Delhi, we have done this. If house is owned and population is more than 25 lakhs, the value will be done on the basis of 15% of the salary. So we take the salary as we have here. What all do we take in the salary? Salary on due basis, basic, DA if a part, all taxable allowances and monetary payments which are not in the nature of perquisites. So what do we have here? What all do we consider? We shall consider basic 240. DA, it's a part, 24,000. We'll consider this also. Commission, fixed or not fixed, we shall take it. Lunch allowance, 5,000. Children education allowance, as much as is taxable, that is 1,000. Medical facility, we will not take. It is taxable as part of salary, but we will not take it for the purpose of value of the house. Why? Because medical facility is a perquisite, and for house we do not consider perk. Had it been overtime allowance, we would have overtime payment, we would have considered. But other facilities we do not consider. So 240 plus 24,000 plus 6,000 plus 5,000 plus 1,000. So together This is 2,76,000. So this 2,76,000 is that salary which is considered for the purpose of valuation of the house. Of this 2,70,000, the house being in Delhi and owned by the employer, the value would be 15% of salary. So value of the house would be 15% of 2,76,000, that is 41,400. So taxable salary after your basic salary, after your allowances, after your perquisites comes out to 3,18,600. Standard deduction we have discussed a number of times before, 50,000, and therefore taxable net salary would be 2,68,600. Had this house been given to the employee for not the entire year but say for 6 months, then of this 2,76,000, the salary would be calculated for the entire year. But for the purpose of the house, the salary that we have for the whole year, which is 2,76,000. So we have 276,000. Of this, we shall first find out half. So of this 2,76,000, we shall consider salary for 6 months. And of that salary, we shall find out 15%. So 15% of salary for the period for which the accommodation is occupied by the employee. Had it been 10 months, 276 into 10 by 12, 15% of that. Had it been 4 months, 276, 4 months and 15% of that. So we have a little comprehensive question, little wider components of question where we have calculation of the salary simultaneous to calculation of the components of salary. So in this we are clear of education allowance, we are clear of value of the house along with the things that we have done earlier. In the same question now, we have got the value of the house as 41,400. In the same question, if the house becomes furnished, we have done this. If the house is furnished, the value is increased by 10% of the cost if the furnishings are owned by the employer, or higher charges if furnishings are hired by the employer. So here, if the house is furnished, the value of accommodation would be, given that furniture is owned by employer and cost price of the furniture is 12,000. So cost of the furniture is 12,000. But the written down value of the furniture is 6,000. Furniture may have been bought in earlier years and after providing for depreciation, the written down value is 6,000. So we have two things, one cost, two written down value. Additionally, we have furnishings hired by employer and higher charges are 10,000. So what do? To unfurnished accommodation, 41,400, we need to add the value of furnishings, which if owned, the rule says 10% of the cost. Given that the cost is 12,000, we'll take 10% of 12,000 irrespective of the written down value. We ignore the written down value. So it's 10% of 12,000. And higher charges, we take actual, whether paid or payable. So we take the entire higher charges, 10,000. So value of furnished accommodation becomes 41,400 plus 10% of the cost, 1,200 plus higher charges, 10,000. So total value is 52,600. Similar to the house, there's a possibility that you get the house for the whole year, but furnishings you get for 6 months. So if you get in this question we have furnishings provided with effect from 1st April 2020, which means you are given the furnishings for the entire year. Let's say you are given the furnishings for 6 months. In that case, we would have done 1,200 into 6 by 12 and this 10,000 into 6 by 12. The value of the house for the whole year, furnishings value for the period for which they have been given. say 6 months, right? So the same question now. If is given at a concessional rent. So far we have done house free of rent, unfurnished. House free of rent, furnished. Now we have house furnished but at a concessional rent. So you don't have it free of cost, but you are paying a rent for it. So the employer, if charges 8,000 for the furnished accommodation. So we have done earlier, the value of the accommodation is 52,600, which is 41,400 plus cost of furnishings 52,600. But for this, the employee pays 8,000. So a benefit worth 52,600 gets reduced by 8,000 because 8,000 is something that you have paid. So that's not a benefit. So less amount charged by employer 8,000 and therefore value of accommodation at concessional rent now becomes 52,600 minus 8,000, that is 44,600. Had it been an unfurnished accommodation at a concessional rent, it would have been 41,400 minus 8,000. Since it is furnished at concessional rent, we have 52,600 minus 8,000. So we go accordingly. So that's how we find out the value of the house. The next perquisite that we talk about is loan given by the employer to employee. We need to be careful of a lot of things when we talk of loan. Similar to house, loan could be interest free or loan could be concessional. That is, I'm getting a loan free of interest. You are not paying any interest to employer. Or you are paying an interest which is concessional. Say bank charges 10%, employer charges 4%. So I'm getting a benefit of 6%. How do we find out the value of the loan? If the loan is interest free, of course we have a system of valuation. But and this does not just apply to loan or house, it applies to lots of perquisites. Any value could be free or concessional. If it is free, we have a pattern of valuation, we have a method of valuation. If it is concessional, whatever you pay, deducted from the value. This could be medical, this could be education, this could be house, this could be a loan, this could be car, anything. If you pay something, then the concessional value becomes taxable. Now, before we talk of the valuation of loan, we'll talk of a situation when this value is exempt. The perquisite is exempt. When if you take loan, it is exempt from tax. The third category of perquisites. Two cases. One, you take a loan for medical treatment of a disease specified in Rule 3A. So there are a set of diseases covered under Rule 3A. For treatment of that, if you take loan, let's say you take a loan of 1 lakh. And bank on this 1 lakh would be charging 10%. Your employer doesn't charge anything. It's very evident that you have a benefit of 10,000. Had you taken the loan from the bank, you would have paid 10,000 to the bank. The employer doesn't charge anything. So you are benefited to the tune of 10,000. And if this is at a concession, say you need to pay 4%, then the value of loan becomes 6,000. But if this loan of 1 lakh is taken for the purpose of treatment of disease, question will be providing this information. Covered under Rule 3A, then this entire benefit becomes exempt from tax, no tax, except if the amount of loan is reimbursed to the employee. If it is reimbursed to the employee. I've taken a loan, but I get a reimbursement of, let's say, 40,000. So if I get a reimbursement of 40,000 for the medical treatment that I've taken for Rule 3A problems, then that 30,000 or 40,000 which is reimbursed, that becomes taxable at the concessional rate of interest. So if you are not getting anything, As a reimbursement from the employer, it is exempt. If you get a reimbursement, that's an in-pocket benefit, that becomes taxable. 2. If aggregate amount of loan is up to 20,000, so be careful about the amount of loan. Together, aggregate, not per loan 20,000. I take 18, 18, 18, 18 5 times. That makes it 90, taxable. But over the year, if you have taken loan of up to 20,000 for any purpose, be it 3A, be it not be 3A, this is again exempt from tax. Taxable value 0. Other than this, the value of loan is taxable, calculated on the basis of 1. The amount of loan outstanding, that is unpaid. On last day of each month, I have taken a loan of 1 lakh and let's say I start repaying it with effect from January. So April to December, let's say April to December, I have loan outstanding worth 1 lakh. So for these 9 months, I shall pay tax on the value of loan computed on the basis of 1 lakh at 10% rate of interest. 1 lakh into 10% into 9 by 12, because outstanding balance at the end of each month is 1 lakh. April, May, June, July till December it is 1. Now January I start repaying 10,000. So end of January, last day of the month, end of January I have 90,000 outstanding. End of Feb, 80,000 outstanding. End of March, 90,000 outstanding. So for these 3 months, Jan, Feb, March, I shall be finding out the value for each month. Jan, 90,000, 10%, 1 month. Feb, 80,000, 1 month, 10%. March, this would be 70, reduced by 10 each month. So 70,000, 1 month, 10%. So every month your balance gets reduced, and on the reducing balance, you will find out the value of the perquisite. So what do? Find out the outstanding monthly balance on the last day of the month. I start repaying the loan on say 20th of Jan. So I'll not go day to date. You go last day of them. So if you repay on 20th of Jan, on 31st of Jan, out of 1 lakh I have repaid 10, my balance is 90. So you calculate interest on 90. Similarly, subsequent months. What rate of interest? What is the rate of interest? My employer is not charging anything from me. I am getting a free loan. The rate of interest would be the interest charged by SBI, State Bank of India. A similar loan could be housing loan, it could be educational loan, it could be a car loan, it could be any purpose. So for the same purpose, on the first day of the previous year, for our purpose 2021, for 2021, 1st of April 2020, if I take education loan from State Bank of India, what is the rate of interest that SBI would charge? Say 10%. So the taxable value of the perquisite becomes 10% of the amount of loan that is outstanding on last day of the month. And similarly, we find it out for each month. And summing it up, let's say we will find out the interest for this period. 9 months 10%, 1 month 10%, 1 month 10%, 1 month 10%, whatever is the total that we have. If you have paid anything to the employer, less we have the amount paid to the employer. So if you are paying anything, then the value gets reduced by the amount that you are paying to the employer. So we have a case similar to the example that we have just talked about. X takes a loan of 30,000 from his employer on 1st April 2020. You have it right at the beginning of the year. That's just simple cases. If you have it in the middle of the year, we reduce the value by the comparative number of months. And the loan is taken for treatment of disease covered under Rule 3A. So if you have taken loan for treatment of disease under Rule 3A, we have done, it is exempt from tax, no tax, whatever amount of loan. Second say. The second case says, X takes a loan of 1 lakh from his employer on 1st February 2020. 1st Feb, that is on 1st April 2020, the loan is there. At a concessional rate of 9%, which means you are paying 9% to the employer. You've got it at a concession of 9. Possibly bank is charging higher than 9, but you are paying 9. And X will repay the monthly installment of 10,000 starting from 15 Jan 2021. January, say, from January, you have started repaying the loan. How much? 10,000. Which January? 15 January. So we have to see the outstanding balance on the last day, 31st Jan. SBI rate, 10%. So SBI would charge 10, but your employer is charging 9. So what's your benefit? 1. So the tax would be paid on the amount of interest calculated at the rate of 1%. Your income is to the tune of 1%. So how do we find out the taxable value? Similar to the example we have discussed, April to December, no repayment. Repayment starts from Jan. So April to December, your loan is 1 lakh for 9 months. Rate of interest 1%. 10 minus 9. SBI rate 10. What you are paying to employer? 9. What is your benefit? 1. You are saving 1. So the taxable amount would be 750. On 31st Jan, your outstanding balance becomes 90 because you have started repaying with effect from 15 February 10,000. So 90,000, 1% for 1 month. Because every month the balance is going down, so every month your amount principal would be different. So every month rate of interest would be different. Similarly, for February, this is 80,000, 1% 1 month. And similarly for March, 70,000, 1% for 1 month. So we have these figures and the total amount would be 950 as the taxable value of perquisite on account of interest-free loan. If for this loan of 950, let us say you pay to the employer 800. Now this becomes loan benefit at a concessional rate of interest. So it would be 950 minus 800 and taxable value would be 150. The next perquisite that we have is use of movable asset. Now we'll talk of use and transfer. There's a difference. Use is you bring it home or in office, use it, return it. Transfer is the employer has given it to you, again free of cost or for some sum. Now for use of movable asset, the value is 10% of the cost. Simple rule, 10% of the cost. Whenever you may have bought it, you bought it last 10 years. You bought it for 1 lakh. But today, 10 years ago, you bought it for 1 lakh. And today, the written down value of that may even just be 20,000. Basically, when you are using an asset, you are using an asset worth only 20,000 because it has been depreciated to the extent of 80,000. But the rule says 10% of the cost. Ignore WDV. Written down value of the perquisite would be 10% of 1 lakh. That is 10,000. And if it's higher charges, like we have done in earlier cases. Concessional value, whatever you pay. For this 10,000, if you have paid 2,000, the value would be 10,000 minus 2,000. And when is this exempt from tax? If the asset that you are using is a computer or a laptop. So if you are using a laptop, then the value of the perquisite is nil. It is exempt. Other than laptop or computer, the value is 10% of the cost. So simple valuation in case of use of asset. If the asset is transferred, given to the employee, then again, we need to have sense of certain things. The asset has been bought by the employer some time back. Let's say the employer bought an asset for, say, 1 lakh. Simple case. He used it for 1 year, which means he has taken the benefit of depreciation of 10,000 and now the value of the asset is 90,000. He has used it for another year. Let's say we are talking of depreciation on straight line method. So another 10,000. The value of asset is 80,000. Now this asset is transferred to the employee. So what are you transferring? You are transferring the asset worth 80,000. So what will be the value of the asset? 80,000. Because you bought it for 1 lakh, you have taken the benefit out of it worth 20,000. Now you are transferring an asset worth 80,000. Value is 80,000. So basically cost minus depreciation. But when we talk of depreciation, we have to be careful again of 2 things. One, the period for which the asset is used, and we need to take the completed years. Let us say the employer has used it for 2 years and 8 months. So do we give depreciation for 2 years, 8 months? No. Depreciation is given for 2 years, completed years. So we ignore the period of 8 months. And second thing that we need to know is the method of depreciation. For certain assets it is written down value, for other assets it is straight line method. And third thing that you have to be careful about is the rate of depreciation. It could be 50, 20, 10. So keeping that in mind, this is how we find out the value of movable asset in case of transfer. We shall first find out the wear and tear, depreciation. That is till the time it is transferred, it is used by the employer for business purpose, official purpose. And it is provided for completed years and not part of the year. So, part of the year is ignored for the purpose of finding out the depreciation. Now, for the method and the rate. For all electronic gadgets, computer, electronic diaries, data storage devices, the method is written down value and the rate is 50%. If the asset transferred is car, the method is again written down value, the rate is 20%. And if the asset transferred is other than this, household appliances, you have a microwave, you have a washing machine, there is a fridge, or even a, now see, here computer is taxable. Transfer of computer is taxable, but use of computer is exempt. Be careful. For other assets, rate is 10%, method is straight line method, SLM. So SLM is the method, straight line method, but rate is 10%. So we have a case here. The company transfers the assets, which assets? To car and fridge on 15 December 2020. So the assets have been transferred on 15 December 2020, but they were purchased by the employer on 17th April 2019. So from 17th April 2019, they have been used by the employer till 15 December 2020 before they are transferred. They were bought for car for 5 lakh, fridge for 25,000. And selling price, now this is again concessional, not free. Fridge has been transferred for 14,000 and car has been transferred for 3 lakhs 20,000. So what do? Cost less depreciation for completed years. That is the value. And if you are charging anything from the employee, then the amount charged to be deducted, balance is the taxable value. So cost on 17th April 2019, car 5, fridge 25. Depreciation for the first year, 17th April 2019, first year finishes on 16th April 2020. So it's a day before. So till 16th April 2020, you have not transferred, you transfer on 15th December. So you claim depreciation for the whole year. Car we have done 20%, 1 lakh. Fridge 10%, 2,500. So the balance after 1 year, that is 17th April 2020, is 4 lakhs, and for the fridge 22,500. Now depreciation for the second year will not give depreciation for the second year. Why? Because second year would be 16th April 2021. But the assets have been transferred on 15 December 2020. So prior to completed 1 year of use, the assets have been transferred, and for part of the year we do not provide depreciation. So no depreciation for the second year. Otherwise, it would have been 80,000 in case of car and same 2,500 straight line method for the fridge. So the taxable value would be 4 lakhs and 22,500 if the asset is transferred free of cost. However, our question says you have transferred it for 320, car 14,000, fridge. So for car we deduct 320, for fridge we deduct 14,000, and the value of these assets would accordingly be 80,000 for the car and 8,500 for the fridge. So cost less depreciation less amount paid by the employee. Then we have food and beverages. Cost to employer is the value of food or beverages. Employer spends 5,000 on you, 5,000 is the value. But this is exempt up to 50 rupees per meal per day. So let's say your employer spends 120 rupees per day, per meal per day, and provides you this for 360 days in a year. Normally we don't work for 360 days in a year, let's say 300 days. The value of the perquisite is 120 multiplied by 30, but it is exempt up to what? It is exempt up to 50 rupees. You have once a day, so per day multiplied by 300. So what will be the taxable value? Taxable value would be 120 into 300 less 50 into 300, or straight away you can do 70 into 300. This could be a direct meal or a meal coupon. You can go and transfer it and cash it at a eating joint. Anything you pay to be deducted. So if it is 120 for which you have paid, let us say 20, so that also gets deducted. 50 is exempt, 20 is what you are paying, so taxable would be 50. 120 minus 50 exempt minus 20 what you are paying. And this perquisite is exempt, totally exempt, if the food is provided in a remote area or an offshore site during working hours or during extended work. So at the working place it is exempt, but off the working place, at the working place it is taxable beyond 50 rupees. Off the working place it is exempt from tax, fully exempt from tax. And refreshment and non-alcoholic drinks, remember non-alcoholic beverages, exemption is given on non-alcoholic beverages. So refreshment and non-alcoholic beverages during working hours, even in office. Refreshment is different from food, we talk of snacks. So refreshment and non-alcoholic beverages during working hours or extended working hours in office, and food during working hours or extended working hours outside the office. That would be exempt from tax. And then traveling, touring and accommodation. If the traveling, touring or accommodation facility is uniformly available to all employees, whosoever goes, you get the same benefit. It's simple cost to the employer. He spends 10,000, taxable value 10,000. You pay 4,000, taxable value 6,000. I told you in the beginning. For any perquisite, if you pay anything to the employer, the value of the perquisite gets reduced by that amount. It becomes a concessional value. If the facility is not uniformly available, we have different benefit for different categories of employees, then the value is that value which is offered by other agencies to public, because you are not offering it to the public. So the value is to be done at that rate at which the facilities are offered by other agencies. Your employer has given you free. Had you gone to an outside agency, what would they have charged from you? Maybe they had charged 20,000. So taxable value would be 20,000. Less what you pay, concessional. And other than this, if the traveling or accommodation is extended beyond official tour, or not for you but for any of the members of your family. I go on an official tour and get an accommodation, my family accompanies me. So whatever amount the employer is incurring on providing the benefit to my family, that would also be taxable. So that is how we find out the value of perquisite on account of traveling, touring and accommodation. So for the next presentation, we shall talk of the remaining perquisites as also the other components of salary like provident fund and interest on provident fund. Thank you.